All right. Thank you everyone for joining us here today. We'll be those are here for the intro part. We'll be celebrating tonight because we're talking about how to save a ton of money on your taxes through something you may not even have thought about before. The stuff you throw away when you're doing a rehab or other kind of renovations. I'm joined here tonight with one of my partners, Ramesh Nachapan from with Beyonder Holdings, and we've got with us today Kevin Jerry. And those who may have seen before, Kevin did a presentation with us last December discussing cost segregation kind of as a general high level topic. Today, we're getting down to the nitty gritty on one specific area of that, the things you throw away when you're doing a renovation, things that you may not even thought that you could, capitalize on and save money from your tax on it. We're going to be digging into that a little bit. This is hopefully the first of a four-part series. We want to do a quarterly webinar with Kevin discussing different topics of the cost segregation area to help you find ways to save tens of thousands, if not hundreds of thousands, or even millions of dollars in your taxes, depending on what project you're working on. Kevin has, of course, a very extensive background, lots of professional experience, a speaker around the world on this topic and multiple subjects dealing with cost segregation and taxes. He is a tax expert, so I'm not the one to answer your questions. He'd be the one to answer your questions for you. And there will be a Q&A at the end to you come on and ask anything else that you specifically want to know regarding what we talked about tonight or something else. And also feel free to put some questions into the chat, which we can get to either during the presentation or at the end as well. And with that, Kevin, I'll turn the time over to you.
Okay, yeah, thanks, Don, and thanks for having me, and thanks for kind of putting this together for all of your people. What Don's doing for you guys, you don't really know it now, but you will down the road when you start looking at all the opportunities that he's helping you understand, and how they really will help you save taxes at some point, maybe now, maybe tomorrow, maybe a year from now. But the more you know about this, and the more you have at least a cursory understanding of what the opportunities are, the better. So I'm not sure even who said it, but there's two types of taxpayers in the world. Those are who are informed, and those are who are not informed. And the informed taxpayers always pay less. So what Don's trying to do is get you at least informed about the basics. We don't expect you to really understand even all of this or even some of it today, but if you understand a little bit, and then you keep joining us down the road, we'll just keep adding to what we're talking about today. So we're gonna today, what Don had mentioned earlier was we're gonna talk about stuff that you throw away. And then how does that even impact your taxes? Well, it does, and it definitely can. We're going to kind of set the stage, and we're going to go back and just have a couple minute review of the stuff that we talked about the last time, just in case you weren't there, because we're kind of building on that initial webinar that we did. But if you weren't there, or if you forget, or if you didn't really even understand it, that's fine. You're not supposed to understand all of it, but we'll just review, and then we'll kind of get into the meat of it. I don't know, I hope you guys don't mind, but I put a little Bible quote on the bottom: give back to Caesar what is Caesar's, which is Jesus said that in Mark 12, and then I threw in my little 2 cents in there, but no more. Give to Caesar what is Caesar's, but don't give more to Caesar than Caesar's asking for. And what we're trying to do here is avoid you overpaying your taxes. Everybody has to pay taxes. And to some extent, it's a good thing. It's great for our roads and great for our military service, but you don't want to give more than you have to. And that's what we're talking about today. We don't want you to pay more than you absolutely have to. Here's all our contact information. If you do have any tax questions, reach out to me directly. Otherwise, you can just go through Don. He and I communicate every other day. So whatever you send to him will eventually get to me. So there's 4 opportunities I want to talk about today. The first couple will be just a cursory overview. It's cost segregation, how to change the depreciation on your building. And then the next one is we touched on a little bit is, well, when you start putting money into your building and you start fixing stuff, repairing stuff, replacing stuff, what do you do with that? Do you have to depreciate it, over 27 and a half or 39 years, or can you just expense it? And there were regulations passed in 2014 that are very much in your favor that will allow you to expense a lot of it. But you've got to understand the basics of what the requirements are so that you can meet the requirements and not do anything gray. And what we're talking about today is not a gray area. It's not a loophole. Don and I didn't look at the regulations and come up with a creative interpretation of them. They're in black and white, but they're so complicated in black and white that it gets to the point where even a lot of tax attorneys don't understand this stuff. And this is not your CPA's responsibility, by the way. It's not their skill set. They didn't learn how to do this in undergrad or grad accounting. I finished my graduate degree in real estate taxation, and this never came up. So this is outside what you pay your CPA to do. It's not it's not their responsibility. They're not getting paid to do it. So who's the onus on? Who's the responsibility on? Look in the mirror. It's you. Unfortunately, CPAs they do wonderful jobs at accounting, but tax is not their, that's not accounting. So they're kind of two separate skill sets. So then we're going to talk about partial asset dispositions, which is you get money for your garbage. And then I also want to touch on what's called a safe harbor. Safe harbors from the IRS is kind of an administrative convenience for the IRS and for you as a taxpayer, meaning these regulations are so complex, they're so hard to understand. The IRS says, look, we're going to give you 3 opportunities. Just do the best you can with it. You get it wrong, we're not going to come back and audit you. But we've come up with 3 different ways so you as a taxpayer don't have to go through the myriad of tax nonsense and regulations. And you can just look at 1 or 2 or 3 and say, okay, I'm going to do this. I'm going to do this for my building or my asset. And if I get it wrong, I get it wrong. But the IRS says just do the best you can with it. And so they tried to simplify the most common circumstances where you will need the regulations and understand the regulations. So they came up with 3 easy to understand safe harbors, and it is simplified, and they have done a really good job at this. So that's kind of what we're going to touch on today, but just know you can use this right now. This is not for tax planning. This is for actually tax year 2023. If you haven't filed your taxes yet, you can use every single one of these right now, and hopefully we can impact almost everybody's taxes. And so the first one we're just going to touch on is cost segregation. We talked about this before, and it's a tax method change that's optional, and you can change the way you depreciate your building. Typically, a CPA will take the entire cost of the building and depreciate it either over 39 years if it's commercial or 27 and a half if somebody lives in it. But there's another way to do it. It's been around for about 25 years, and all of this is a very large building in Manhattan, and all of this has to stay in a 39-year class life, because when you talk about depreciation, you talk about class life, and a class life is something that Congress and the IRS set up so that your asset, whether it's a car, whether it's a computer, whether it's an office furniture, or whether it's a building, you can reduce your taxes as that asset starts to wear. And the class life was set up from the IRS and it says, this is how long this asset should last before it's to the point where it's in a total state of disrepair and it's almost unusable anymore. Now, that has no bearing in reality, none, because a computer has a class life of 5 years. Well, the computer I'm using right now is 7 years old. A car is 5. I mean, I know Don's car is a hell of a lot older than 5 years old, and so is mine.
Yeah.
But nonetheless, they have to, put something in there to be able to do the simple math, which is the cost of the asset divided by the class life. So when you have a building like this is the structure, and the structure has to stay in a 39-year class life. How they came up with 39? Who knows? It used to be 31, and then they made it 39. So it's a little way that the IRS can increase your taxes by reducing your depreciation expense, but not tell you. And nobody wants to, as a president, say, "Oh, I increased taxes." No, but they change the class life on a building so that less depreciation can be taken, so there's more income and more taxes are paid. But that's neither here nor there. So this is the inside of that building. All of this can be depreciated over 5 years. And here's the rule: the shorter the class life, the less taxes you pay. Because if you think about the mathematical equation, cost of the asset divided by the class life, a smaller denominator, and I know we're going back to elementary school math here, so bear with me, but the smaller the denominator, the bigger the expense. So if you have 100,000 divided by, or a million divided by 39 is 2,200, but a million divided by 10 would be 10 times that. And if it's a 5-year class life, it would be 20 times that. So changing the class life creates more of an expense that you can do in the current year. And we have plenty of time to do cost segregation studies. In fact, we can do them all the way up to September of this year for tax year 2023. Now, why did I put this slide in? I don't even know. So, but this slide, you can see all the stuff on the inside of a building, and all of this, I mean, all of it can be depreciated over 5 years. So this is a great opportunity for cost segregation. This is not. This is the inside of a parking garage, and there's nothing there. So the kind of rule with cost segregation is, if you can take it and rip it off the wall, rip it off the floor, put it in your car, take it away and sell it on eBay, you can accelerate the depreciation. There's not much you're going to be selling on eBay here. I guess if you go in and you steal a tile or something, you could sell that on eBay, but there's nothing there. But RV parks are great. Why? Because the inside of these little cabins what the depreciation can all be accelerated. Because on the inside you can take out whatever's in there, probably a lot of the flooring, maybe some of the kitchen and the bathrooms and stuff, and you can take those out and you can sell them or get rid of them. So the IRS says, if that's the case, the class life is now 5 years, which is great, because right now, without cost segregation, the class life would be 39. And now we're going to make it 5. So that's very impactful. Here's all these pads we can put in a 15-year class life, which is phenomenal. So we're going from 39 to 15. Now, not everything in an RV park, let's say, or an office building or strip center can be accelerated. Maybe 25, 30% in a like a medical building or office building can be accelerated. RV parks, though, are awesome because it's upwards of 50 and 60% can be accelerated because of a lot of the land improvements. A lot of these paths and roads and stuff can all be accelerated. So that's the background of cost segregation. But to talk about what Don was talking about earlier, where the partial asset dispositions, where you're getting money for the garbage that you threw away, you have to have the study done. So this has to be done. So that's kind of why I'm bringing it up. It's also a phenomenal tax opportunity. There's no amended returns. There's no chance of an audit. I mean, this is absolutely bulletproof. So what cost segregation does is, this is a federal depreciation schedule, and you can see that I'm going to take a chance here, and I'm going to try to bring up an arrow and see if this works. It never does. So here's the building. This building was purchased in 2007 for $2.4 million. Is being depreciated over 39 years. This is very, very common. What cost segregation does, though, we turn that depreciation schedule into this, where we put a value on all the different components. And the ones on the left side can be depreciated over 5 years. Everything up here can be depreciated over 15, and all this has to stay in 39. So that's what cost segregation does. But you can see, I mean, we can go down to the penny on a roof, down to the penny on HVAC. And when let's say you're going into your building and you are doing a renovation or improvement, and you're getting rid of let's just pick something good. You're getting rid of all the doors and frames. You're just getting rid of it. A cost segregation study, one of the benefits, besides an immediate impact on your taxes, is you see this 14,658. Well, that's the value of all the doors and the frames. Now, if you renovated your building and you got rid of all the doors and frames and put new ones in, you can expense $14,658. And that sounds kind of simple. And let's say you replace your roof. Okay, now you can take a one-time expense of 28,000. And I'll get into why that is, but just know that a cost segregation study is fundamental for taking advantage of a lot of tax opportunities when you own real estate. It's not just accelerating the depreciation and taking that deduction in the current year. There's a lot of things you can do with a cost segregation study, as long as whoever's doing the study understands taxes. Now, if they're just an engineer and they're just going through and doing the calculations, they're not going to give you too much guidance here. But if you can find a firm that has engineering and taxes, now you've got a really formidable partnership here. So what we're going to talk about is partial asset dispositions. And when you do a renovation, expensing all of these items or any of these items that were thrown in the garbage. And it doesn't matter. Okay, it doesn't matter if this building was built in 1980, you bought it as a property owner in 2023. You're like, oh my man, these cabinets are like from the dark ages. They're not worth anything. Yes, they are, because the depreciation clock starts over again when you buy a building. Even if it's purchased in the 1800s, built in the 1800s, doesn't matter. When you buy it, the clock starts ticking again. And all of these items are brand new from a tax standpoint. They're all brand spanking new, as if you went to Home Depot and spent 80 grand on an HVAC system, put it in. That's how, from a tax standpoint, these values are created. They're created as if they were new. Now, if you've had your building for 20 years, that's a little bit different. So you have to calculate the roof and the HVAC when you originally bought it, and then do some inflation calculations and whatever to figure out, okay, what is it worth now? But if your building is 5, 6, 7 years old, the opportunity is incredible, because what you throw away, you can expense. The value of what you throw away, you can expense. And we'll get into that a little bit more. I know it's probably kind of fuzzy right now. It doesn't make a whole lot of sense how you can actually expense garbage. That's just silly. So cost segregation was kind of one. Yeah.
Just wanted to interject real quick to highlight what you said there, is that, like you said, if somebody were to buy a property, you may think, yeah, it's already 50 years old. It's already been depreciated, expense. It's outlived its lifespan, like you said. But like you said, if you're buying it new, it's new to you. So the government sees it as new depreciation, new expense. It starts over. It's not like it's already been depreciated. There's nothing more to depreciate. You do it again, and the next guy that buys it from you will start over again. So that 39-year life could last hundreds of years, recycled each time somebody new buys it.
Yeah, thanks, Don. And please interject if I'm not making any sense, or if you can clarify anything you say. that I say, please jump in. Taxes get complicated, and I make a lot of assumptions. I've been doing this for so long that I make a lot of assumptions, and I should not make assumptions. But yeah, exactly. So it's new to you. That's what I took out of you, what you said, Don. It's new to you. So if it's new to you, then it's new to the IRS. So all of those assets are basically, from a tax standpoint, brand new. I don't care if they're 100 years old. Right. So cost segregation is the changing of the way you depreciate. Then there were rules that were introduced in 2014 that determine, okay, here's my building. Now I'm putting money into it. Do I depreciate that, or can I expense it? And that's when it really gets complicated. And that's that. But when it gets complicated like that, just know the more complicated it is, the bigger the opportunity. Now, if it's super low hanging fruit and easy, the opportunity is going to be good. It's better than nothing. But when it gets real deep and complicated and thick, that's where that's where the opportunity is. That's where the money saving is. So these regulations were passed in 2014. They are mandatory. They're not optional, like cost segregation. You own a building, you have to follow these, but they'll save you money if you do. That's kind of what blows my mind sometimes. Is you've got a mandatory regulation, and I have to do it. If I don't, I'm going to get in trouble. But if I do it, I save money. And that's what's so hard for a lot of people to understand. But that is absolutely true. Truth is stranger than fiction. You can't make this stuff up. But these are mandatory regulations that will help you save money. And this, what Don was talking about, that we'll call it the partial asset disposition, or a PAD. A partial asset disposition is when you have an asset and you get rid of a portion of that asset. Let's simplify it. Let's say you buy a car for your business and you don't like the engine. And so you get rid of the engine and you put a new one in, some, hot rod V8 engine or whatever, and you put it in your car, and then you're looking at your driveway. Well, I got an old engine there. What do I do with that? You can expense the value of that engine as if that engine was new. Even if the car is 20 years old, it's like, okay, well, I bought Mercedes and put a V8 engine in it, but the old Mercedes engine has a value because the asset is the car. And when you dispose of a portion of that car, whether it's tires, whether it's engine, whether you get rid of the transmission, the seats, whatever, you can take the value of those seats, of that transmission, of those tires. You got to calculate the values, and then you can write those off, and you can expense the value of those as if they were new, minus any depreciation that was taken. So if you're buying a 20-year-old Mercedes and you're putting a new engine in, you can expense the old engine as if it was brand spanking new. And this is missed by 95% of the CPAs out there. And I wish I was exaggerating. I'm not. It's actually more like probably 99. And the reason is, for one thing, the regulations are complicated. The second reason is that they never got taught this stuff in undergrad accounting or in grad school. It's not on the CPA exam. And third, who's going to put a value on that engine? Now, an engine's a little bit easier, but let's say you got rid of, we'll go back to the car example, you got rid of the transmission, and you got rid of the engine, and you got rid of the floorboards, and you got rid of the exhaust. Who's going to put a value on all those parts and pieces that will stand up to an audit in case an IRS agent asks? Well, you'd have to have a mechanic do that. It's the same way with a building. When you have a building and you start getting rid of portions of that building and disposing a portion of that assets, somebody's got to put a value on all that to do it. And that's where a construction engineer comes in. They can put a value on it. Once there's a value on it, now it's a piece of cake, because you're just have the value, like that cost segregation study I showed you with the roof and the windows and the doors and frames. You just add those up, say I got rid of all of those, and on your schedule E or C, however you do it, you're going to take a one-time expense of the value of those components. And it's but if you don't do it in the year, you got rid of that stuff, you can't do it. So if you did renovations in 2023 and you're looking at your taxes now and you see, oh my gosh, I put a new roof on, we did some renovations, we expanded the building. Reach out to Don or myself. Send us like your construction document or your spreadsheet of all you spent and what you did. We'll calculate it and we'll say, okay, you can take a one-time expense of all this stuff. But again, if you file your taxes for 23 and you don't do this, but you had an opportunity in 23, it's gone. And that's another reason why it's missed so much, because there's such a pressure to get tax returns done quickly, especially if you procrastinate like I do. And so CPAs they just got all this information. They've got to get the return out. The deadline's next week. They don't have time to calculate how much the screws and the bolts and everything were that you threw away in your renovation. So that's why this is swept under the carpet so much. Not that nobody's doing anything illegal, nobody's doing anything wrong. It just has to do with timing and complexity. And as a CPA, I don't get paid enough to save my client money. I got to do their taxes, keep them out of trouble, do the financials on time. I don't have time to try to look at all different opportunities to save taxes. But that's where we come in. We work with you and your CPA to do that stuff.
Hey, Kevin, real quick question for you. In the example of your car, like you said, taking out the old engine, you expense that old engine. What happens to the new engine? Because I guess in my mind, if I were to do this, I'd say, okay, I'm going to expense the new engine cost, not even worry about the old one because it's trash, right? Garbage. So how do you, is there a way, do you capitalize on both of them? You expense the old engine and then capitalize the new engine, or is that only one or the other? How's that work?
Yeah, the new engine has to be capitalized. When you impact a large portion of an asset, and you're affecting a large portion of the asset, the IRS says, look, this isn't just repairs and maintenance. You're not only affecting a large part of the asset, but you're putting in an engine in that's better. And when you make an asset bigger, better, faster, stronger, or impact a large portion of that asset, the IRS says that always has to be capitalized.
Sure. Okay.
Always.
So
Yeah,
great. So again,
it's a real good point.
consider as real estate again, if you're like say replacing the roof or flooring, whatever you said, so you can basically get the best of both. You're getting the expense from the stuff you're throwing away, and you're also capitalizing on the new stuff that's going in. So it's almost like, I guess in a sense, double dipping, I guess, on saving your taxes.
Yeah, it is. You get to depreciate the new, let's say, roof coming in. But if you don't expense the old roof, now you're depreciating two roofs. You've got a roof that's on the original asset on a line item that says building. In there is a roof, along with electrical, plumbing, and all that kind of stuff. But a roof is in that dollar amount. And then you put a new roof on, and if the IRS says, yeah, this has to be depreciated, but you don't expense the old roof, now you're depreciating two roofs. It's called a ghost asset. And we talked about this last time. One of the roofs is in a landfill somewhere. And so why are you depreciating that? And so the argument sometimes I hear is, oh gosh, I can get, I can depreciate two roofs. Isn't that great, Kevin? No, it's not. Because one, you are depreciating it over 39 years. So let's say it was 100 grand, you're getting a whopping $2,000 a year on it. But when you sell that asset or when you sell your building, depreciation gets paid back, and it gets paid back at 25%. So not only are you take a little bit of a deduction where you could take a big deduction and just expense the whole thing, but now when you sell your building, depreciation reduces your basis and it increases the long-term capital gains you pay upon the sale. So that's depreciation is great. Don't get me wrong, but it's not this perfect opportunity. First of all, you got class lives that don't make sense, that are too long. And second of all, you got to pay it back when you sell your building. It's great. You have to take it. But if you can expense something, if you can expense that old roof, now you get whatever, let's say it was $100,000, $100,000 roof, you can expense that roof in the current year, reduce your income by 100 grand, and not have any depreciation that you pay back on that initial roof when you sell your building.
Good. And just real quick, you may cover this later as well, but in the case where it's already been fully depreciated, can you still expense that at some point? Like if you did a cost segregation study back when we had 100% bonus depreciation, and you fully depreciated that piece in that year, and then 2 years later you replace it, expense it. Can you still expense at that point, or is it already gone because you did depreciate it fully?
Yeah, once the rule is done that you can take the original value minus any depreciation that was taken. So let's say if you did, and a roof's a bad example for that, but because a roof is a 39-year asset, unless you bought the building 40 years ago, there's going to be some
Sure.
basis left that hasn't been depreciated. But if you do, let's say a bathroom, if you did a cost segregation study on a bathroom and you put all that into a 5-year category and took 100% bonus on it, now there's no basis left. You depreciate it at all. So if that's the case, then a partial asset disposition is probably not gonna help you much. But we're only talking about kitchens and bathrooms and tile and carpeting or whatever, the assets that you can take out of a building and can be accelerated. But there's a lot of things like framing and drywall and interior doors and maybe tile on the floor that can't be accelerated. At the most of any, and I hate to say this building, but because you've got warehouses and you got medical buildings, you got a building is such a wide range of of possibilities, but only maybe 20 to 25% can be accelerated, even a best case scenario. So if you do renovations, yeah, that 25% you're not gonna be able to take a pad on, but the other 75% you can. So yeah, if you've done a cost segregation, taken 100% bonus on stuff that was disposed of, the bad news is you can't do a pad. The good news is you can recost segregate that all that new stuff and put that back into 5-year and take 100% bonus on that. So no, it's not a perfect world, but it's damn close.
Sure. Well, even in this case, we're talking about 2023, right? You only had 80% in bonus
Right.
depreciation, so there should still be something there you could still expense, right? And then
Yep.
obviously for this year going forward, even more so, unless something changes with legislation. But okay, well, either way, good to know. Good to have that clarification.
No,
So
let's jump in. Please do. And I've read a lot of articles about the House actually passed a bill that approved to take along with 50 other regulations, but in that 100% bonus was coming back. Now the Senate dragged their feet. They're still dragging their feet. Now they're on vacation again, and it may come back, and it may be retroactive for 23. I don't see how they can do that. It'll probably be for 24, but bonus will probably come back again, and that is great news for
yeah,
all real estate investors.
for sure.
I'm not going to talk about this, but I wanted just to put it up here that when you have an expenditure like a roof, or like you get rid of your car engine and you have a new engine coming in, you have to follow rules. And if that asset or expenditure can pass 4 tests, that rule, that then no matter what you did, no matter what you spent, if it passes these 4 tests, you can expense it. It doesn't matter if it's $1 billion roof of I don't know, the Mercantile Exchange, whatever, the biggest building in the world. You replace the roof, you spend $1 billion. If it passes these tests, it can be expensed, and that freaks CPAs out because they see, oh my gosh, the $300,000 expense. Oh, the IRS is going to flag this all day long. They may not. But if you follow the rules and expense it, all you're doing is following the law. There's nothing they can do about that. They just would have to ask, show me, the $300,000 invoice and what it was for, and to go on their merry way because you're following the rules. But just know that the dollar amount you spend on a repair and maintenance or an improvement or replacing a part has no bearing on whether that's expensed or capitalized. Zero. And that's a hard concept to swallow when you've been taught over and over that if the expenditure is big and it's expensive, you depreciate it. And if it's small, you expense it. But that partial asset disposition, which is what we're talking about today, is part of these regulations. So I want to at least touch on these regulations so you have a basis or a foundation to kind of try to understand this stuff. You got cost segregation over here, tangible property regulations over here. This is optional. This is mandatory. It starts to get confusing. But if we build this slowly, slowly, hopefully you'll start to catch on. Okay. So I mean, and it took the IRS 10 years to come out with those regulations. We've done a ton of work on it. I'm not going to bore you with this, but we've saved probably clients over, I don't want to exaggerate, $300 million in taxes with changing the depreciation, doing partial dispositions, taking repairs that were done in the past and expensing those. So there's a lot of opportunities here. And just know, as this gets more complicated, the opportunities gets bigger and bigger. What we're going to, here's all of the subsections of that regulation. It's code section 263 small a, the tangible property regulations. Here's everything all laid out. We're going to touch on just the green stuff today. We're going to touch on repairs, the safe harbors I was talking about, and then partial asset dispositions. And this will go very fast because once you understand the basics of what the regulations, why the regulations were put out, and they were put out because the IRS was tired of going to court and losing about how, you get some super sharp tax attorney who says, oh no, look at this regulation. This says that roof can be expensed. Then you get another super sharp IRS attorney who says, no, look at this regulations. It has to be depreciated. So you had all this conflicting information, and the IRS said, enough, we're tired of this. We're going to come out with regulations that everybody can understand, and that trump, no pun intended, trump all the other regulations, so that when you start spending money on an asset, in our case, the building, you know what to do with it. So if you got insomnia, start reading this stuff. You won't get to page 2 before you get to sleep. Okay. What we found is there's a lot of vertical markets that for partial asset dispositions and stuff, which are great. Campgrounds, apartment buildings, hotels, residential rental, even RV parks are phenomenal. And then some, but some are not. So why do I have a picture of some guy screwing in electrical switches? Because I want to show you in these regulations, I want to show you what they say and how they're structured. These are about 300 pages. They don't say, well, if you spend this, do this, or if you do that, do this. There's none of that. That's called a bright line in tax speak. It means that it's obvious. It's light. It's something that you can kind of really get your arms around and truly understand. These regulations don't have any of that. So they just have example after example after example after example. I don't know, 120 examples, and you got to take what you're doing with your building and try to line it up with an example so you can decide whether to depreciate it or expense it. That's why with CPAs and a lot of owners, like, I can't understand this. It's too hard. It doesn't make sense, and it doesn't. But that's why we're here, because we've been doing this for 15 years. But here's what I mean by they're complicated and there's no bright lines. You got a guy who owns a building. His name's R. Very creative. R changes out 30% of his wiring. Okay, great. 30% of his wiring. What does that even mean? How much did he spend? It doesn't matter what he spent. Just know that, as a rule of thumb, if you make an asset bigger, better, faster, stronger, you have to depreciate that expenditure. And it gets really complicated of deciding, okay, what is bigger, what is better, what is faster, what is stronger? How do you quantify those? And the examples do the best they can, but just know that these regulations are super complicated. Don't blame your CPA because he can't figure them out, or doesn't want to figure them out, or doesn't want to take the chance. It's like, what if I get it wrong? And so if I'm going to take a chance of getting it wrong, I'm going to get it wrong being super conservative so that my client doesn't get audited and have penalties and interest or anything. But that client's still overpaying their taxes, which is what we're trying to stop. But somebody's got to read these examples, and somebody's got to say, okay, this is what I'm doing in my building. Here's an example that meets that, and now I know what to do. So that's why these are ignored in a lot of cases, because they could be looked at as risky, which they are absolutely not. You just have to understand them enough, which will absolutely totally mitigate the risk. Same with an HVAC. Here's R again. R's a busy guy. He bought a building with 10 roof mounted units. He replaces, I don't know, I think he's replaced 2 of them. Yeah, he replaced 2 of them, and they're 10% more efficient. He doesn't have to capitalize this either, because it only made the building bigger, better, faster, stronger by 10%. And 10% is not enough for the IRS to say, okay, depreciate this stuff. So why am I showing these regulations? Not just to bore you or put you to sleep. I'm showing them because I want you to see that the opportunity's there. It's there in black and white, but somebody's got to read it, and somebody's got to interpret it, and somebody's got to put their butt on the line and say, this is what we're doing. This is why we're doing it. Here's the tax forms. We'll sign the tax forms and take responsibility for it. But the opportunity is there, and it's being ignored, especially that partial asset disposition thing. We see more roofs replaced than probably anything else on a building. And I don't get it. My parents had the same roof they had when I was growing up on their house. And I mean, it lasts for 50 years. Now roofs apparently don't last 50 years because they're being replaced constantly. But roofs are very, very common, whether it's shingles or whether it's membranes. And here's another example. But just know that if you replace the shingles or a membrane on a roof, and that's all you do, the IRS doesn't see that as bigger, better, faster, stronger, or a lot bigger, a lot better, a lot faster or stronger. They just see it a little bit, and a little bit is okay. A little bit you can expense, a lot you can't. But they are really common, as far as the opportunity, because remember, when you have a roof, and a roof can be pretty darn expensive, and let's say you buy your building, and you say, oh man, this roof is leaking, I didn't see it coming, and you have to spend $100,000 to get that roof redone, and it has to be depreciated. Just know that you can expense the old roof, and which is what the whole premise of this presentation is how do you take advantage of and utilize these partial asset disposition expenses. We're gonna take a little bit of a step back, and I want to cover the safe harbors real quick, Don, and because the safe harbors are easy, and the safe harbors are simple, and the safe harbors are designed for smaller taxpayers. So I want to just cover those, and then we'll get into a little bit of PADS, and then we'll kind of wrap up. But the safe harbors are something that everybody can do and understand today. The first one is the de minimis safe harbor. De minimis is Greek or Latin, I don't know. It means trivial, minimal. It's like, yeah, I don't even want to bother with that. So what the IRS says is, like, if you are going into your building, or you're down in your campground, and you're replacing a toilet here, a kitchen there, flooring here, trying to think, windows here, and you're doing it kind of as on an as needed basis. If it's under $2,500, you can expense that all day long. I don't care if it makes the building bigger, better, faster, stronger. You can expense that. Now there are some little bit of rules. You got to have an invoice. Okay, the invoice has to show that the toilet, the bathroom, the kitchen, whatever, the sink, whatever you replaced was $2,500 or less. And you can expense that all day long. I don't care if, now what you can't do is have a major renovation and say, oh, the drywall was under 2,500 bucks, the carpet's under 2,500 bucks, this is under 25. That's abusing the de minimis, because you've got an overall renovation or effort or a big expenditure. You can't take each portion of that and use the de minimis safe harbor to expense all that. It's designed to, throughout the year, on an as needed basis. If it's $2,500 or less, the IRS says, we don't want to touch it, just expense it. Okay. Now, if you, let's say, I do have to clarify, let's say you buy a computer, where typically a CPA would depreciate a computer, but with the de minimis, you can expense it. So what happens if the computer is 2,400 bucks, but the installation and training are $6,000? Now you're up to 3,000. Now you're over the $2,500. What do I do? The IRS says change the invoice, separate the invoice so you have the computer on one, installation and training on another, and then that way you can utilize the de minimis. So if it's under $2,500, just expense it. Just don't even worry about it. Then there's another one called routine maintenance. So let's say, Don, you've got your RV park, and in Louisiana, let's say every 6 or 7 years, you're going to have to redo the pavement. You're going to have to redo the pads. You're going to have to redo the roads, because the sun and the water, it just destroys that, especially, or in the Midwest. Ramesh, you have that all day long. You're constantly running over potholes. So what the IRS says, if you're spending money and you're just keeping the asset in its everyday normal operating condition, you're not making it better, you're just spending money to keep it nice, and you expect to spend that money again in 10 years, the IRS says expense it, because it's routine. You're going to have to do it again. Again, it doesn't matter if let's say you're redoing your pads, Don, and they're I don't know, $2 million to redo the pads. If you think you're going to be redoing those pads again in 10 years, you can expense that immediately under routine maintenance safe harbor and not ever look back or worry about somebody questioning you on it. And the cool thing is, you don't even have to do it. You don't even have to do it in 10 years. You just have to have the intent to do it based on your experience, based on manufacturer's warranty, based on how long blacktop is supposed to last in Louisiana. All those factors. It's called routine maintenance. And again, it doesn't matter if it's $1 million, $100 million, or 10. You can expense it if you think you're going to do that again in 10 years. This, I have, in 14 years of doing this, not 14, it's probably about 12. I have never seen a CPA take advantage of this. Not one, not once, because they don't understand it. And it's like routine maintenance. Well,
Right.
Anyway, so Arizona,
I
great.
think like you get confused about the amounts too. Like you're saying, in that case, like a $2 million replacement, it's like, oh, that's a big amount. You might as well depreciate it, not expense it, right? I think,
Right.
like you said, there's a lot of confusion about just the amounts, as you said before.
Yeah, the amounts don't matter anymore. It does not matter in these regulations, whether we're talking about partial disposition, safe harbors, the four rules I said, have to be passed to expense and expenditure. Not once, nowhere does it discuss how much it was. Not once. So it doesn't matter how much you're spending. If you follow the rules and and the facts and circumstances lay themselves out as such, you can take advantage of these regulations. Okay. And then there's one more And it's called the small taxpayer safe harbor. So if you have a business that's under 10 million in average annual gross receipts, 10 million in revenue, and the asset's worth less than 10 million, you can use what's called the small taxpayer safe harbor. And it's only for businesses with gross receipts under 10 million. Now, like Don, I know you've got a lot of different RV parks out there, but each one is its own trade or business. Now, and so the same with the small taxpayer safe harbor. You could be a huge landowner and you could have 50 buildings. Each one is its own separate LLC, and you could take advantage of this because, yeah, you may be over 10 million, of everything combined. But if we're looking at just each individual trade or business, it's not over 10 million. So you can take the lesser of 2% of the unadjusted basis of the building. And all the unadjusted basis means is it's the cost of the building minus depreciation, without depreciating. You haven't factored in depreciation. So it's the lesser of 2% of what you paid for the building, or $10,000. So if you have a $400,000 building, you can, no matter what you do, what you do to that building, including making it better, including making it more efficient, including making it worth more, you have 2% of that $600,000 building, or $10,000 to spend any way you want. It really, this is also overlooked also. But so let's say you've got $1 million building, you can use $10,000, and you can use this for every separate trade or business that you have. We'll just say, let's just call it $10,000. You have $10,000 to spend any way you want that you can expense, and without the IRS even looking at it, because this is a safe harbor that the IRS set up to make it easy on you. So if you've got if you've got maybe student housing, I'm trying to thinking of places I've used this before, or because every house is a different trade or business. Strip centers are really big on this, but you have $10,000 that you can spend any way you want. Now you can't spend $10,001 because that kills it. But you have $10,000 to spend any way you want. So those are the three safe harbors. You've got the small taxpayer, then you got routine maintenance, which is just, I don't know, phenomenal. And then you've also got the de minimis of $2,500 or less. So you've got three opportunities that are very easy, very simple to understand, that you can take advantage of right now. The fourth one is the partial asset disposition. And this is what I pulled out of the regulations. It's from Code Section 168. I'm not even going to read it, because I'm reading it and I understand what they're trying to say, and this doesn't make any sense to me. You start throwing in therefores and here twos and legalese, and then no wonder nobody does it, because nobody can even understand what the hell the IRS is talking about. But what it means is, what we talked about before, let's go back to the engine. You have a car, you get rid of an engine, you can expense the value of that engine. You have a building, you have a roof, and like Don said, it's got to be depreciated. You get rid of the roof, you can expense the value of that roof as if it was new. It's from Code Section 168K, and it's also merged into the tangible property regulations, which are the regulations for depreciation versus expense. So this is a very common opportunity, but it is missed. It's missed all the time because nobody has the time to do it. Nobody has engineers who can put a value on all this stuff, like a mechanic would put a value on your engine. You need a construction engineer to do this. So it's missed, but the opportunity is enormous. And I really don't want, I can't stress it enough, that to take advantage of this in the year you do it, because if you don't, I mean, it will be gone forever. And I'll show you an example. This is a guy named Billy. He's a client of mine, super nice guy. And he wanted to know, could he expense this roof? and and looking at it, it's like, no, no, Billy, you're going way beyond repairs and maintenance on this. You're making that roof better. I can see you're making it better, and stronger and more efficient. And he argued a little bit, but then he admitted, man, I really am. This is a brand new roof. It's supposed to make the building, worth more money. I don't know if it was metal or whatever, but nonetheless, he could not expense this roof. Under any circumstances would I allow him to expense this roof. But this is all the crap that he
Mhm.
threw out. This is all the old roof. I said, Billy, this is money in the bank. This is what you can expense. So we did, it's think of an engineer, doing a swan dive and dumpster diving into the dumpster and looking at everything and putting a value on it and measuring it and putting it in his little calculator. That's what we did. We put a value on every single part and piece of the old roof, and we saved him enough taxes that it actually paid for the new roof. So you can't expense the new roof, but you can possibly, depending on how old the building is, save enough on taxes by what you threw away to pay for the new roof. But you've got to do it in the year that you got rid of the old roof. And in addition to this, but wait, there's more. But wait, all of the dumpster can be expensed. The guys with sledgehammers can be expensed. The guys up on the roof tearing out the old roof can be expensed. All of that can be expensed as well with that partial asset disposition. You can also expense the cost of demo and the cost of remediation and the cost of removal. And it is I don't want to keep beating a dead horse. I think you get it. But what you could save here on garbage can actually pay for that new expenditure coming in. I hope that's about it. I think that, oh, yeah. And this is where I'm running out of steam here, but this is where the cost segregation study comes in. Because if let's say you renovated the interior building, we could say, oh, cabinets worth 10 grand, moldings 3, wall coverings 9, interior half walls 8, accent lighting 3, et cetera, et cetera. And we add all those up. You got rid of it all. Now we have an absolute bulletproof calculation to determine the value of everything that was thrown away. That's why cost segregation is so important. Without this, we could not do a partial asset disposition, because how are you going to calculate the canopies and the awnings unless an engineer has done their calculations and figured out the original cost of those? And that's why a cost segregation study is so important. But if you just use it to take a one-time tax deduction, you're only using it halfway. You're paying for it. You're paying for the whole thing. Use the whole thing. Use it for partial dispositions. Use it for determining capitalization versus expense. Use it. It's there. The calculations are there. You paid for them. You can take that cost seg study and you can multiply the tax savings you get from it by doing the other things, the other opportunities that Congress and the IRS has given you that require some sort of engineering calculation done up front. And that's the beauty of cost segregation. It's not a commodity. There's good companies or bad companies, but there's other companies that understand the taxation side of it, and that's what makes this so critical. Because any engineer can do the calculations, but to take those calculations that apply to tax code, that's a different story. And that's as a building owner investor, that's who I want in my foxhole. Okay. This is just a recap of everything we talked about. We don't have to go through it again. If you want this deck, reach out to me or Don. I'll be more than happy to send it over. So that's I know we went over a little bit, Don, sorry, but that's kind of where we are.
No problem. Yeah, thanks for the presentation, Kevin. We do got a couple questions in the comments here. They're kind of similar, so I kind of combine them, I guess.
Okay.
Everything you've been talking about here sounds like it's more commercial related. Commercial buildings, strip malls, apartment buildings. Can this be, I guess, used in residential at all? If somebody has like a single family homes or short term rental type of thing, or is there fourplexes? I guess is there a minimum amount where it makes sense to do a cost segregation study, or these things can be expensed or capitalized?
Yeah, that's a great question. No, as long as you don't live in the building, as long as it's not your primary residence, whether it's a residential rental, whether it's an Airbnb, whether it's a RV park, whether it's a warehouse, whether it's the Empire State Building, the law applies to all rental property, rental property, commercial property, rental property, as long as it's not a primary residence. These rules are all encompassing. They're a big umbrella over everything.
Okay, perfect. All right. Any more questions from anybody else here that wants to maybe unmute and ask questions? We'll take a few more minutes if we can do this. Anybody has any questions?
Yeah, don't be shy. If you got a question, lay it out there. Maybe you'll end up stumping one of us. But no, this is not easy stuff. And if you can come away with 10 or 15% of what I talked about, and you really understand it, you've done great.
Okay.
Okay. Well, you got our you
Yeah,
got
I'll
our
say what
information.
I've got one question myself. I'll maybe a selfish question here.
Sure.
So when does it make sense to do the cost segregation? I could say in the case of a new construction, if someone builds a brand new strip mall, you don't have the tenants infilled or the tenant improvements done inside yet, so it's just like a shell of a building. Does it make sense to do a cost segregation at that point, or would you want to wait until all the tenants are filled in and you've done your tenant improvement costs that go back to the owner to pay part of that? I mean, is there a certain point where you should do it or not do it or wait or?
Yeah, and then that is the crux of cost segregation is when do you do it? Because you don't have to do it in the first year. You can do it any time throughout before you sell your building. I would say, Don, that when your income is enough to offset the depreciation expense that cost segregation is going to create, and it can create a lot. And so if you have a little bit of income and you're in the 20% tax bracket, I'd say wait until you have a lot of income and you're in the 35% tax bracket, because otherwise the depreciation, unless you're a real estate professional, which is something we can talk about next time, but unless you do real estate for a living,
Mhm.
the IRS will not allow you to take that additional depreciation that offsets your income from that building and apply it to your other income.
Yep.
So what it would create is a net
Mm.
operating loss. So you'd have to pay the fee for the cost segregation. But if you only have 10 or 15,000 of income, but you have 150,000 in depreciation, you're going to suspend that to the next 5, 6 years before you utilize all that depreciation, or you can wait until you have $150,000 of income or $100,000 of income. Now the depreciation is going to wipe that out, and the fees that you pay us or another company to do that cost segregation will be much better spent rather than just creating a net operating loss and rolling it forward. Just wait until you have the income and then do it.
Yeah, makes sense.
Yeah.
Okay. Anybody else have any questions yet? Maybe Ramesh or anybody else in the audience?
Yeah.
Uh, Kevin went in detail, so it's good.
Thanks, Ramesh. Always good. You're always a cheerleader for me. Thank you.
Yeah. Okay. Let's take one more question that popped up here. So it says the accelerated depreciation saves you from upfront taxes, but we have to pay back at the time of selling if we are selling the property for gain. Recapture costs in K1s. I don't know if this is a question there, I guess, or I guess for the recapture then, how's that? How do you handle the recapture the depreciation at some point? Um,
Yeah, so yeah, the depreciation, the government giveth, the government taketh away. So yeah, depreciation is great. But then yeah, when you sell your building, that depreciation expense reduces your basis and you pay taxes on the difference between the basis and the sale price. So a lower basis means you're paying more of it. You're paying more long-term capital gains, but you have to take depreciation. You have to, even if you don't just tell your CPA, I'm not taking the depreciation expense. You still have to pay it back, even though you never took it.
yeah.
So Yeah, depreciation is great. Accelerated depreciation is awesome. And the reason is because depreciation is not indexed for inflation. So let's say you've got $1 million building, you depreciate over 39 years, you're getting a $22,000 tax deduction every year off of your income. Well, what are you able to do with that 22,000? And then let's say you can buy maybe a used car today. In 10 years, that 20, you have that same 22,000, and now what are you able to do with that 22,000? Maybe buy a watch, buy an engine, buy some car. 20 years from there, it's worthless. It's absolutely worth nothing. So depreciation is not indexed for inflation. You don't get more depreciation expense as inflate to take advantage of or to offset how much inflation is wiping away at that. And when inflation was 1 or 2%, it's not that big of a deal, but inflation is out of control now. It's 6, 7%, 8% a year. Now that depreciation, your expense, your depreciation expense and your buying power from that expense is getting smaller and smaller and smaller and smaller because inflation is wiping away at it. And the government knows that, the IRS knows that. And so what we're trying to do with cost segregation is slow that down. We can't stop it, but we can maybe take 20 to 25% of it, flip it on its head, give you tax savings that you can take and invest. Give it to Beyonder, buy an owner, be an owner of an RV park. It's phenomenal. Take it and use it. And then now you're slowing that down, and you've got it now. You've got it. Inflation actually working for you. Where now you can take that money that used to go to the IRS, invest it, grow it, and then so that when you do sell your building, now you've made enough money from that tax savings, in theory, to be able to offset any additional taxes that you may incur when you sell your building. So it's the inflation that killing your depreciation expense right now, and what you're able to do with it. That cost segregation, in my opinion, really is the most that's the most important part of what we're doing here.
Yeah, Kevin, I would like to add one more probably along those conversations. I know people always, you know, we all know the recapture happens and that has an impact, right? But when you look at it might be different for each property, so I cannot give you a firm example, but still, say you invest $100,000 over the 5 years, along with your cost segregation and bonus depreciation, you have done like 150 write-off, right? And you
Right.
come back and sold it for $200,000. You're Kevin, correct me if I'm wrong. So technically, you will be only paying for $50,000 capital gains, even though recapture happens.
Yeah, so yeah, you're on the right track here, Ramesh. So it's when you have your accelerate, first of all, if you 1031 it, that
Yeah, it's
then now
different.
you're not doing it. If you do 1039 it, you're not doing it. If you give it to your kids, you don't have recapture. If God forbid something happens to you and you pass away, and it goes to your kids, now there's no depreciation recapture. So there's a lot of ways where depreciation capture can be totally avoided. But if you do decide, I'm getting out of real estate, I'm going to pay the long-term capital gains, I'm going to go live on an island somewhere, I'm not 1031ing this, I'm not owning any property anymore, yeah, you're going to have to pay the piper at some point. But remember, depreciation is recaptured at 25%. And even if you're in the absolute highest level tax bracket, federal, you're only at 37%. I mean, if that's 37%, that's worst case, you're paying 13% more when you sell your building. That's nothing compared to what Beyonder Holdings can do with $100,000, how they can grow it. It's a drop in the bucket. So when I hear, investors or owners get kind of wrapped around the axle on recapture, I have to pull them back and say, look, let's take a look at this, at all everything that has to happen for you to truly have to pay that back at its highest rate. And it's only 13% more than if you didn't do a cost segregation. So, and then you take it, and then you think of all that, everything that Beyonder could do, or somebody could do with your money who's smart and can invest it and grow it and double it, triple it. Now it's that recapture is really truly meaningless.
All right, well,
If
we've
you
got
keep
the
recycling the investments, this all happens when you really stop
Yeah.
it at some point.
Yeah, you
exactly, yeah.
stuff the money, you take the money we save, you stuff it in a mattress. That's not doing any good. But if you give it to somebody who can grow it and multiply it, that's the theory behind cost segregation.
Exactly. All right, for sake of time here, we've got a few more questions. We'll cover these, and then I think we'll call it a day.
Okay.
So let's see here. So somebody asked about what about partial rental property? I think they're similar like a house hack situation because you have a triplex, you live in one unit, rent the other two. Can you still do the cost segregation on those other two units, excluding your part that you use as a primary? Is that
Yep.
possible?
Absolutely, positively. It happens all day long. Yep.
Okay, great. And what's the average cost of a cost segregation study? I assume there's going to be variance looking at a giant commercial property versus, say, a triplex. But what's your kind of, I guess, average cost
Anywhere
expectation?
between 3,000 as a low or 2,500 as a low if it's just like a single family residential rental, and it's going to cap at about 12 or 15,000 for even a high rise building. It's not linear; it doesn't go up as the basis goes up. It starts to level off at about for us anyway. For about $15,000 is about as much as we can charge.
Yeah, great. And I'd say even with that, somebody might see that that's still kind of a high cost, but honestly, what you get back from that cost segregation study is going to save you much more than that, multiples of that in your taxes. So it's well worth it for sure.
Yeah.
Um,
Yep. And then
okay.
not just the current year. If you use the cost segregation study correctly, you can use it for the next 10, 15 years.
Oh yeah, definitely. It carries forward if you can't use it all in the first year, yeah. And then somebody asked here, you mentioned the being a real estate professional to be able to really offset your other income. What does it take to be considered a real estate professional, especially for someone that works, I guess, hundreds of hours?
Yeah, it's if you work hundreds of hours, it's almost impossible because the IRS says you have to spend. Then there's two requirements: 750 hours a year managing your rental properties, which comes to 20 hours a week. But you also have to spend at least as much time managing your rental properties as you do your day job. And then now you're talking about if you work a 40-hour week, you have to spend 80 hours working. And so it's almost impossible. There was a couple of cases where it did make a fireman can do it because a fireman, will work, gets paid to sleep. And they may work 40 hours, but they may be at a firehouse for 2 days, and that's 40 hours. And a tugboat captain, the same thing. He's on call and he's working, but he's not really working unless he gets called. And those are the only two circumstances I found in the last 10 years where somebody could say, okay, I spend as much time managing my real estate as I do my day job. Now, if you have an Airbnb, that's a different story because an Airbnb is not a residential rental, and the real estate professional status only applies to residential rental property, whether it's single family or multifamily. But if you have an Airbnb, now the IRS says, well, that's kind of like a hotel. And a hotel is not a residential rental property. So if you have an Airbnb and your average stay is 7 days or less, and we create $100,000 depreciation expense, and you only have $10,000 of income, that 90,000 can offset your day job. But the rental has to be 7 days or less. Now the IRS may change that. It's almost like too good to be true, but Airbnbs are not rental. They're not long-term rental. That's what the IRS is trying to avoid. Taking
It's not housing, it's hospitality, right?
Yeah, yeah, it's hospitality. Thank you. I should have said that.
Yeah.
We'd be off the phone right now. Yeah, absolutely.
Yeah. Yeah, fantastic. Well, that's awesome. I actually didn't even know that myself. That's great information right there. Very cool. All right. Well, again, thanks everybody for joining us tonight. We'll let you get your evenings back. But again, we look forward to doing more of these webinars, covering more topics in the whole cost segregation world, I guess, to get deep dives on specific topics coming up at least once per quarter. Maybe we'll do more. Who knows? But obviously, if you have questions about anything taxes specific, reach out to Kevin. He's definitely the one to answer those for you. And if needed, reach out to myself or Ramesh. We also direct you to Kevin and get your questions and things to him. He's definitely the expert to talk to. A replay of this will be available on YouTube, and those that have registered will get a copy sent to them as well. And those are listening later on, please subscribe to this channel and be alerted to when new information like these comes up in the future. Again, thanks everybody for joining us tonight, and we'll talk to you soon.
Okay, thanks, Don. Thanks, Ramesh. Okay.
Thank you so much, Kevin,
Yeah.
Brock.
Bye.
Thanks, Don. Yeah, thank you, everyone. Good night.